in the ATM space, you sort of have two different kinds of operators. One is you have a mom and pop operator. They'll run around, and as you can imagine, it's a very sensitive business, one that you can't just hire some low-level employees to run around and stuff cash into the machines and service machines. It's so mom and pop operators typically are operating these ATMs themselves personally. They're servicing the machines, they're putting cash in machines, and normally they tap out about 150 to 200 machines in a 50-mile radius.
Okay.
So you have that model, and that model can be very lucrative. That can be a great business. As in any real estate investing, it's what are the top three most important things in real estate? It's location, location, location. Especially so in the ATM space, because the ATM space, when you break it down, it's really a real estate play. You're monetizing a small piece of real estate. Maybe I would argue, probably one of the most profitable per square foot in any kind of real estate that you can invest in.
Wow.
So that's the one kind of operator. You have the mom and pop operator. The other operator is an institutional operator. That's the Cardtronics of the world. Multi-billion-dollar companies, publicly traded. All of their services are done by third-party, fully audited service providers. Think Brinks and Loomis to deliver the cash. Think, there's cameras all over the place. These guys are, fully audited. And so normally the regular Main Street investor doesn't have access to invest in an institutional grade portfolio unless they, buy shares of Cardtronics. Wall Street, they go through Wall Street to get there. What we've done is we've created a model where our team goes out and plays with the Cardtronics of the world. They take down these large institutional grade portfolios of ATMs, could be 5, 10, 15, $20 million portfolios. And then we'll bring them back down to Main Street investors. We chop them up in bite-sized pieces, and regular investors can get access to an institutional grade portfolio, and they can invest in it. One unit consists of 6 ATMs, and the investment amount is $104,000. Accredited investors can come in and take a $104,000 piece of this institutional grade portfolio and derive some great cash flow. Cash flow is obviously the biggest piece of this investment, but when you wrap the 100% bonus depreciation around this, and you get it to the point where you can now keep most of your cash flow because of the tax impact, it can start to make a whole lot of sense to an investor.
Right. Okay, super cool. So I kind of want to break it down as if it could either be if a newbie, has some real estate experience, maybe they want to get into ATMs, or even your guys' process, but I know you guys kind of do it on a larger scale. I'm thinking just for the basics on a smaller scale. So first and foremost, ATMs are kind of all over the place. Obviously you see them at banks. What are some other common places that your ATM machines are at?
Yeah, so first thing, and you mentioned banks, just because the ATM is in a bank doesn't mean it's bank owned. Like typically banks don't want to mess with this kind of thing. So we've got a lot of ATMs in banks. And the other thing to remember is just because it's free to the consumer doesn't mean that it's free. Just because when you walk into Wawa and it's a free transaction, you use your ATM, which by the way is a great business model. Now you can get cash and then you turn around and buy cigarettes or lottery tickets or chips or sodas. That Wawa is still basically all they're doing, all the bank is doing, and all that convenience store is doing. They're picking up the tab. So
gotcha.
If that costs $3 or $3.50 to get a $20 bill out of there, they're picking up that tab. So they're
Gotcha.
Just because it's free doesn't mean just because it's free to the consumer doesn't mean that it's free. They're picking up the tab on that.
Got it. Okay.
So the business model really is just putting an ATM where that your customer spends a lot of time at. And so it's really, you would never think about putting a C or D class apartment building in an A class neighborhood. I mean, it
Right.
just doesn't happen. And the same way as you wouldn't think about putting an ATM machine, you won't see ATM machines in a Louis Vuitton store. It's
Right.
not the right kind of customer. And typically the person who is interested in investing in an ATM machine is not an ATM user. I own several hundred of these ATMs, and I don't have an ATM card. I don't even have access to get cash out of an ATM machine. I never have a need to.
Right.
But we're dealing with customer base is unbanked, underbanked, EBT card carriers. It's that kind of a customer. And when you consider the fact that, despite the new technologies that came along, 10 years ago already,
Right.
Think Apple Pay, Google Wallet, some of those, now you have a whole host of other ones. Despite all that, the use of cash increased, not decreased like many people think it did. There's more than twice the amount of cash in circulation than there was 10 years ago.
Right.
More than 20% just in the last year and a half. And so when you look at that, and then you look at the demographic that we're serving, one of the fastest growing populations in the country, it just, you get to see, the business model and why it works so well.
Right. Okay. Interesting. So for these ATM machines, do you go buy the actual machine from an ATM machine distributor? How does the, I guess, that front process work with actually getting the hardware, the actual machine itself?
So we're buying them by the container loads. We're getting them shipped in overseas. We're buying them direct from the manufacturer.
Okay, got it. And then when you go to a Wawa or gas station or, a bank even, what does the arrangement look like? So obviously, if the bank, for example, is giving that service for free for the customer, I guess, do you pay them rent and then they pay you a fee? How does the actual money move between you guys and the end business that has it in their business?
So there's a couple things. One is we're taking down, think large chains of, think Walgreens, or think one of the larger chains of deli stores in, let's say, New York City. We're taking down large, we're talking to the institutions on that side as well. It's not as simple as when you're a mom and pop operator and you walk into a family owned liquor store or something like that, and you'd say, well, hey, can I put an ATM here in the corner? Our conversations are happening at the board levels for,
Right.
Big companies. And so we're winning a contract. We're unseating somebody. When we're going in and taking over a portfolio, we're unseating somebody. We're not going in and putting a whole bunch of new ATMs and saturating the market into new locations. And that's important for several reasons. One is you don't have the saturation effect. Number two is you're taking out a lot of the risk. There is no guesswork. When we take down a portfolio, we know exactly, like part of our due diligence period, just like you would do, you'd get a T12 for an apartment building. You'd want to see the 12-month history of the rents and have they been paid and all that. We're doing the same thing. When we buy a large portfolio of ATMs, we know exactly how many transactions that portfolio will deliver for us, because we can go back and see the last couple years of history.
Thanks for watching that clip from the Real Estate Investing Made Simple podcast. If you want to see the entire interview, go ahead and click the link in the description below. And don't forget to subscribe to stay tuned for all future episodes.